All right, so I'm James Ng with Full Capital. Thanks everyone for joining. We got Jeremy Roll here. Jeremy, most people on the call know your background, so what I thought we'd do is sort of start here. And the themes that I really came across, sort of the 60 or so people who had already sort of registered for the event, these were sort of the themes. And maybe you can touch on these and then we'll dig into questions, maybe specific questions that people have, and go from there. Does that work?
I'm happy to do whatever is best for you, James. I appreciate the fact you have me on, and I want to apologize to everybody on here that I was a couple of minutes late. Sorry.
No worries. So here we go. So these were, do you want to take these one at a time? I have 5 topics. Do you want to take them one at a time, or do you want to see all 5 topics and sort of address them in unison?
I'd say we do one at a time, but honestly, I'm letting you lead the charge. I'm happy to do whatever is best for everybody out there. So
okay, all right. Let's just take them one at a time. It's a little bit easier for people following along on the call. I know I watch a lot of webinars, so let's just start with current state of the multifamily market. What is the Jeremy Roll current state of the multifamily market?
I feel like we should be asking you that question. So.
Well, we'll start with you. I'll give my commentary. How about that?
Great.
Is that fair?
Fantastic. Yeah.
Okay.
So, I would say anybody out there who's listening, James' opinion is probably going to be a much better one than mine. But so current state of the multifamily market. I guess the best way I would describe it is, and this ties into it, which is, in my opinion, we're recording this in September of 2020. COVID is with us. Stimulus is kind of weaning off. We're uncertain, right? What's going to be happening. And my opinion is that the recession has been delayed. And the question is, what does that recession look like once the delay is done? And what I mean by that is, and this affects multifamily, obviously, what I mean by that is, once we see what happens with stimulus wearing off, what's it going to look like for the renters that we have, right? Can you hear me now?
Yep. Sorry, okay. I muted you.
No problem.
I was trying to mute some background noise. Go ahead. Keep going.
No problem. So what I mean by all this is that, for example, I just read some stats recently. I think 30% of renters claim to have used some type of stimulus to pay rent, for example, in July, like some of the most recent data, right? I think that depending on which data you read, between 25 and 40, and some people say even 50% of renters are at risk of being evicted after there's a moratorium on evictions, right? So the current state of the multifamily market is that there's money that was given to some of the tenants that they wouldn't have otherwise had because, we had 18 plus million people collecting unemployment benefits. 18% of workers collecting unemployment benefits in July, for example, and they wouldn't have had this excess cash that they got. Many people which were earning more money sitting at home versus actually working, and therefore they had kind of extra money they wouldn't normally had, and multifamily market was great. Rents were collected, everything seems normal. And aside from a little dip we had in like the March-April timeframe when the stock market originally had a very severe drop and the stimulus wasn't yet in effect, that was when the recession was real, and now it's been delayed ever since. And so the big question is, to me, is not what is the current state of the multifamily market, it is what's it going to be after we have a presidential election and we see what type of stimulus exists at the beginning of next year. So sorry for the long answer, but current state is it's fine, right? I mean, we have people getting artificial money that are using that money to pay rent, but that could be very different in a few months from now.
That's pretty good. I mean, what I'm seeing and sort of from the transaction side is that, everybody who had deals sort of January, February, March, if it didn't sell, they just put it on hold. And then for the last 3 months or so, it has come back very strong. And so there's a ton of deals on the market and the competition is back in terms of people. Before the cap rates were probably 5 to 6. Now the cap rates are probably low 4s to low 5s. And so the competition is definitely back. And, the debt, there's really no discount. So the pricing is the same as it was pre-COVID.
So James, I have a question for you actually, because I had seen this kind of common phrase come up over and over that I saw, which was the 10% COVID discount on multifamily. Okay. And I saw that happen probably in some deals that I saw in like May, June, July. In your experience, that 10% COVID discount, is that pretty much gone at this point? Is that what you're saying?
On price per unit, yes.
Okay.
I've seen it maybe 5% off. The main discount is on the debt. So before you were underwriting 4.5% debt. Now you're underwriting 2.5%, 3% debt, and that is
Okay.
where the difference is, not the price per door. The price per door is the same.
Yeah.
Yeah.
Okay.
All right. Second question: markets you like for multifamily?
Great question. So, multifamily is one of my favorite assets. I invest in all different types of asset classes. It's definitely one of my tier A asset classes going forward for predictability, because the way that I invest, and a lot of people out there are going to be different, but I invest for more predictable cash flow. So I invest in highly occupied buildings that may or may not have any value at upside as a business plan going in. Now, when you consider that, I'm looking for more stable markets. So I try to avoid the more volatile markets in terms of pricing, like in New York, LA, San Francisco, and I would even throw in stuff that's been hot recently or in the past few years, like Denver and Seattle. Even though I love those cities, it's not something that's a fit for me. So I try to stay away from what's hot. I try to stay away from what's volatile, and I frankly would love to be investing in areas that have projected population growth, right? So there's a lot of good markets out there. And I think there's a lot of well-known good markets out there, and there's also a lot of good markets that make sense from population growth that maybe aren't as well-known. So for example, if you take Florida, because I think a lot of people realize now it's one of the top 2 projected population migration states for the next 10 years. I'm sure some people are familiar with Miami, and they're familiar with Palm Beach, and they're familiar with Jacksonville, right? But I've invested in many markets in Florida, and there's a lot of submarkets in Florida, like a lot. And by the way, some of those may be really good, maybe even have better value, but also may benefit from that population migration we're talking about as a general notion, right? So I like to look at stuff that other people aren't looking at. And that also means that I have to be very open to considering any market, really. And so when someone asks like what markets I like, I actually think the answer being better for me personally is more what I don't like, because I use a process of elimination when I'm trying to figure out where to invest. So I've invested across 43 different states, okay, in 18 plus years. And a lot of that is either direct, but possibly some in non-direct. And I've invested in a fund that then has properties across multiple states, right? Not all that's multifamily. But the point is that one thing I've learned, and I'm actually from Canada, so I really had to learn this. I came here in 1998, was there is a ton of different markets in the US. And if you're really open-minded, there's a lot of markets you've never heard of that can make a ton of sense. And some of them even have a better value than other ones you don't know about. So what I would say is I just look for population growth. I try to stay away from what's hot, and I don't have any specific markets I would recommend aside from the obvious, which is Florida and Texas with population migration, the southern states with population migration, and probably more importantly, staying away from what is likely to have a reduction in population or maybe questionable as far as population growth in the next decade.
Any thoughts? A lot of people in Texas, they're going to Atlanta and Phoenix and potentially Florida. Any comparison in your investments that you've seen from Texas deals maybe to Phoenix and Atlanta? So we just added a guy in Atlanta, and then we're gonna probably add a guy in Phoenix, and then I just got a package from a Texas guy buying a deal in Phoenix. So any thoughts on Phoenix and Atlanta in comparison to Texas?
Yeah, great question. So let me see how I answer that. So Atlanta is a market that I kind of started to see coming up and coming, probably if I had to guess, around 2013, 14, 15.
Okay.
And the way that I work is that if someone's sending me an Atlanta deal today or even last year, it's already way beyond when I want to get in, right? Because I try to stay away from what's hot. So Atlanta, I realize it's probably good for growth, but from a timing perspective, and we're going to put aside the cycle timing, just from market timing perspective alone, it's kind of a little beyond where I want to look because it's gotten too crowded. And so therefore, I can't tell you I've looked at a lot of Atlanta deals that have come my way recently because frankly, I've been a little bit closed-minded to them because it's like the wrong timing for me in that market. The challenge I've had with Phoenix or Arizona in general is that Arizona tends to have more volatility in asset pricing. And what that means is that you may get more appreciation during the upcycle and more depreciation during a downturn. And so I've been on the sidelines mostly since the end of 2016 in fear of a recession because the actual cycle was running very long, or we had an actual record length recovery this past time. And so at this very timing as well, Arizona is not the right market for me because I'd be worried about steering clear of a market where we could have a downturn coming up, and that's a more volatile market for a downturn. Now, that also means that you could go from one of the worst times to consider Arizona to one of the best times to consider Arizona in very short order. So overall, I don't mind that market at all. And I think it hasn't been nearly as crowded of a play as Atlanta recently. So I'd be willing to look at it, but not at this exact timing, but possibly soon.
Did the second quarter, did that count as, obviously it was a recession, but did that count in your mind as a reset? Like now going forward, Q3, obviously GDP is going to be good, but Q4, Q1, 2021, if that's like 2 or 3 quarters of positive GDP, does that second quarter count to you as the recession, or are we just not seeing the impact of all this stuff sort of going through the system? Are we like artificially high on our own stimulus? What are your thoughts on that?
We're like, and I mean, I don't think this is even an opinion; it's a fact, right? We're artificially high on our own stimulus. That's actually what people are using to pay their rent checks with, right? So to me, we haven't. The only effect we saw of the recession was in March and April, arguably, and I actually saw a lot happen in a very quick time period that then reverted. So, for example, we had the normal dominoes fall where people were scared. I actually spoke to 2 sponsors who were trying to close deals at that time, or even get into deals at that time. And they were fairly large, okay? And I knew them for many years. One of them said I was only able to raise a quarter of the equity I would normally raise. And one of them said I was only able to raise a third of the equity I would normally raise. That's what happens in a severe recession. What doesn't happen in a severe recession is that the collections are higher than they were a year ago, right? Like what doesn't happen in a normal recession is that James sits up here, he's an expert, and tells us that the cap rates are lower than they were 3 months ago. Like this doesn't happen. So I'm waiting to see if the dominoes are going to fall or not. But to answer your question, James, and that's going to be a question of how much stimulus we're going to have going forward. Are we going to have universal basic income? There's a lot of questions to be answered. And I think within 100 days of the next election, we'll know the answer is if the party has changed. If the party hasn't changed, we'll probably know what to expect. But the long answer to your question, James, is that, yeah, that's, to me, we haven't actually felt the dominoes of a recession yet. They were very temporary. They were not long lasting. And now everything's artificial. And that's why I say it's delayed.
All right, we'll move to the next one. Changes to your criteria / underwriting post-COVID.
Good question. I would say that what I am waiting to discover, and this is the way that I work as an investor in general, what I try to do is I try to create cash flow targets and cap rate targets for myself for a specific asset class that I'm targeting at the beginning of a cycle. And then I follow along and look for those targets until I can't meet them anymore. And then what I do is I shift away from investing in that particular asset class unless there are unusual deals or exceptions, which there always are. But then I'll keep going on the other asset classes. So what I'm planning on doing post-COVID, which to me also means kind of like post-cycle reset, right? Depending on if there is one or how it's going to work out, is to determine for the next cycle, what preferred return should I be looking to target where I think is like a fair minimum that I should be able to get as an investor. So I draw a line. What minimum year one cash on cash returns would I be targeting from a class B type of multifamily that I invest in? And what type of cap rate should I be looking for as a purchase cap on a more stabilized deal that I'll typically invest in that I think is okay? And once I am able to define those items, I'll take them and use them for the cycle. So that's how my criteria is going to change from this past cycle that just ended to what might be starting soon. Everything else is going to be very, very similar, but of course, I'm going to have to watch markets and population growth and factor all that stuff in as a secondary measure.
Can you give me an example? Let's say Dallas, right? So probably 2014, 2015, you were buying a 1980s deal for 80 a door. Now today it's 130 a door. What criteria are you going to use? Like if I sent you a deal in Dallas right now, how would you evaluate that deal? Like what would you need to see for you to be comfortable in investing in that deal?
Yeah, great question. So if you send me that deal today with the current timing that we have, because it's tough timing for me anyway, the only way I'd even consider it is if there was if you said, look, this deal is like 150 basis points better than the current market rate, I would actually sit down and look at it. Short of that, I probably wouldn't look at it. And I mean, it's that simple actually, because I'm really waiting for things to reset to see where they're going to head. Because the thing is, because I'm so low risk, if I'm going to go in blind at what I consider to be really challenging timing, then I better be really, really careful and create a lot of buffer, right? Because ultimately my hope is to be able to see a shift about 150 to 200 basis points. 200 may be aggressive, as far as like a cycle reset and where cap rates may actually get to before we start the next cycle.
So let's say pre-COVID, everything was like 5% cap rate. Now you want to see something at like a 6.5,
I would
ideally.
like to be at 6.5 and hopefully 7.
Okay.
I'm not saying that's realistic. I actually don't know what's realistic yet.
Okay.
But from a comfort level, if you send me a deal today, I'd love to see something in that range, which I realize is completely, unreasonable.
Just to scare you, I just saw a deal. Residual was in the 4s, so that was the residual, not the going in. So,
I mean, look,
but well,
everything's out there, right? Let me give you an anecdote, okay? The last deal that I invested in Dallas, that what I was called like regular pricing, was in 2013. It was in Mesquite, which is part of the Dallas area. And it was a 1980s garden style, exactly what you're picturing, James, exactly what you mentioned. It was 97% occupied, really good operator. We had a partner dispute, granted. There was a point at which there was a 100 basis point increase in interest rates, so we were able to negotiate a bit of a swap of price. But that building was purchased at a 9.1 cap rate. Okay, so you're talking to someone who's seen that and experienced that, and now you're trying to sell me on a 4 cap or 5 cap, and that's tough. So I want to see where things adjust before I can really get comfortable.
Okay, if I'm recording this, so when we're buying deals at 1 caps, you're going to go back to this and say, I should have taken that 4 cap on that deal.
We could talk about where I think things are going to head in the next 10 years, say, and I'm not necessarily disputing that. I just don't know that I should be buying it at a 4 cap right now when it might be a 5.5 or 6 cap or whatever, it's 6.5 cap in a year from now or 2 years from now. That's what I'm worried about.
Understood. I agree. So let's say the deal comes across your desk. How, I guess in a concise manner, vetting sponsors, vetting deals. Maybe let's take the sponsor piece. We've talked about deals. Maybe talk about sponsors and vetting sponsors and sort of your process and how you get comfortable with a new sponsor.
Yeah, I'll try and get through this quick as possible because I know we can spend an hour on this topic easy. But the really high level is, look, I have to make a bet on somebody I'm going to control, right? And so the key is I'm trying to figure out who am I making a bet on? And what I'm trying to target is somebody who's going to be conservative, who's going to use conservative projections, have the mindset that they're going to underpromise and overdeliver to build long-term relationships with investors. Okay, so from a really high level, that's what I'm looking for. Obviously, you want someone experienced, you want to have a property in the right area, you want the business plan to be in alignment with what you're looking for, but the actual people are really, really important. What I'm trying to avoid is someone who's a great marketer, who's looking to overpromise, throw some really great numbers on the table, use a reversionary cap before, and make the numbers look great. By the way, I hope you're not doing that deal yourself. So I don't mean investing in it, I mean actually sponsoring it. So I didn't mean to offend anybody.
No, I'm not sponsoring the deal, but what's weird is, and it's a little bit of a, just because I think there was like a pause of 6 months where nothing happened. And, there wasn't a lot of deals on the market. There wasn't, and people are just so itchy to get into deals right now, like that they're just pushing very hard.
And you know why? It's because everything's normal, right? Everyone's getting paid rent. Everything looks great. There's no real unemployment problem because everyone's getting paid more rents than they were a year ago. Everything looks normal. And that's why everyone's really comfortable jumping in. Stock market's still pretty high. So we haven't experienced the proper recession. I don't know if we're going to, but we haven't. That's why.
Yeah. So that's, yeah. So to me as an investor, when I'm sitting here, I'm like, all right, well, it seems like a fine deal and everyone's telling me cap rates are going to go down. So I feel like an idiot if I don't put my money in the deal.
Well, I will say this. Look, 10 years from now, it's very possible the cap rates will be below 4, right? That's actually, you can make a pretty strong argument that could be the case. And I actually wouldn't necessarily disagree. For me, I'm just really low risk. So, but I was just making a joke about the 4 cap. So what I'm trying to avoid, though, just to answer the question, is someone who's really aggressive, trying to make the numbers look good, just trying to attract investors, close the deal quickly. And they don't really care about building the long-term relationship. They care about getting deals done. And they have a really good marketing machine. And if you don't invest the next time, they're just going to go on to the next investor, right? That's really what I'm trying to avoid. And so some of the ways that I try to sort out who I'm making a bet on or reading between the lines, I do a lot of that. Of course, sometimes it's a little more obvious, right? If you're reading an offering memorandum and the sponsor says, look, this building is 99% occupied, but we're assuming an 8% vacancy rate to be really conservative. You know, the market vacancy rate right now is 3%, right? That's the kind of thing I'm looking for. I will sometimes ask specific questions about either the pro forma or in this offering docs, just to see how they'll answer, to understand if they're conservative or not as a test. And I'll typically ask usually between 100 and 250 questions is what I'll ask in a typical deal, as I'm trying to vet through it and understand the underwriting.
Wait, hold on one second. What is it? You said you would ask 100 questions? No.
Yeah, I usually ask between 100 and 250 questions. Like
to the general partner?
Yeah.
And they answer?
Yeah. Now, look, I realize an individual investor, that may be more challenging. I have an investor group. I don't want to talk about it publicly because I'm not supposed to, but I have a little bit more leverage to be able to get answers.
Okay.
And in the end of the day, I'm able to ask them, they actually answer, you know, partially maybe because of that, but it's also what I would want to answer for myself if I'm just weeding through a deal. So I'm just very detailed. So yeah, how many questions do you ask? I'm curious.
I usually ask 0 questions. I mean,
is that partially because you're investing with the same people over and over?
Partially. But then also I have access. So usually like deals that I'm invested in, I've already seen the OM, I've already seen the T12, I've already seen the rent roll, I've already driven the property, I already know the market. And so I feel like I know it pretty well and I get the story, right? And most of the guys are doing like an hour webinar where they're going through all their assumptions. And so I might have 1 or 2 questions after that, just something that maybe I missed or need clarification on. But outside of that, I try to be a very limited partner passive guy. So
a lot of advantages, right? Because you've got all this stuff you're already analyzing yourself. Plus you tend to invest very locally, right? Within Texas a lot. So you already know a lot of these areas, where someone like me who's going all over the country, you're trying to like sort out something from scratch. So definitely very different. I think we're on the 2 sides of the extreme, right? Because you can ask 0 questions, or I guess you can ask, you know, a couple hundred questions and everything.
Couple hundred. Okay. So you do all this work. You sort of figure out your markets, figure out the underwriting, vet the sponsors, vet the deals. And now you put your money in the deal. And now what? Like, what do you do with the deals that you are managing sort of post-close?
Yeah, so this is where I'm very much, like you said, a real limited partner, very passive. So what I do is, because I'm so cash flow focused, when I invest in a deal, I will take all the projected cash flows for the next 10 years. I have a 10-year out spreadsheet that goes a little further than that. I'll put in the exact month that I expect each payment, the exact payment. So if something is like $10,000 of projected cash flow in year 3, I'll just divide it by 4. And I'll just say $2,500 in October, $2,500 in February, whatever it's supposed to be. And then when I get the payment, well, first of all, I'll make sure I get the payment in that timing. And then if I get the payment, I would say if it's within about 20%, sometimes 25, but probably 20% of what I expect it to be, I'll just keep going, because I'm in so many deals. And I totally recognize that projection is projection. It's never going to be perfectly accurate, right? And I like to give a little leeway just to be fair. If something's over 20, 25% low, I'll definitely ask questions if I haven't already, and or if it's not been made obvious in the quarterly report, like what is going on here, especially if it starts to get consistent. Like, is this some type of performance problem, or is it a market problem? Like, where is the problem coming from? Is it going to get fixed? How's it going to get fixed? If we're overperforming, I actually even, slightly, 10, 20%, that's great. If it's a lot, I actually really understand what's going on too, right? Is this because the sponsor is doing a really great job and I want to invest with them again because of their execution? Or is it because we happen to pick the right market? And because you got to start differentiating between, like, did we catch the right wave, or is the sponsor really responsible for it? And I think it's important to understand that too. So I kind of check things on both sides when they get a little bit beyond like the typical outlier situation.
So right now, as much as you can disclose, which investments are outperforming and which ones are underperforming? You can be as broad as you need to be.
Sure. Yeah. I would say that I'm trying to, like, I'm in over 60 LLCs. So look, bottom line is I'm in very little office right now, and it happens to be doing very well. But I could see that being a challenge. I'm in a decent amount of retail, and that's generally doing quite well. But more importantly, I think in office and retail, you have to expect that people are going to withhold cash flow to build reserves, especially for tenant improvements, for certain moves in and moves out that weren't anticipated, and possible future stuff that's going to come up. So those 2 asset classes to me, because I'm not in hotels, and I'd imagine that's a whole different thing, but those 2 asset classes to me are being affected in that I'm being affected from the cash flow because of people being conservative with reserves more so than anything. I would say that apartments, mobile home parks, self-storage, all doing very well. I happen to be lucky. I'm in a senior living facility that wasn't hit by COVID, because I think that's like very binary. Either you have a big problem or no problem in terms of being managed properly in that place, in that space. And actually, I want to say, I think that space, depending on the market, you may see some interesting deals come out of that. If a market was particularly badly hit with COVID and it's getting to be post-COVID, right, in terms of a pricing adjustment that may not be relevant in a few years from now. I try to think of other asset classes. RV parks are similar to mobile home parks. They're doing quite well in my experience. I'm trying to, I have some stuff I have one hard money loan left that's actually doing okay. It's about to pay off. I had a bunch of them that have actually paid off over the year. I was out most of my hard money lending at the end of last year, so it wasn't really a big challenge. I'm in a lot of non-real estate stuff we don't have to get into, but I'm not really experiencing, thank God, I'm not experiencing a horrendous shock in anything, frankly, probably except for oil, which got shocked very badly earlier this year and is starting to pick up now, and it's just starting to get back to more of a cash flowing situation.
Okay. That is all the questions that I have probably 40 more questions for Jeremy. But what I want to do here is sort of open it up. If you have a question, maybe raise your hand. I'll try that on Zoom. This is new for everyone. But if you have a question, raise your hand, or you can put it in the chat. I saw a couple questions come through, and we can take those questions right now. So I have more questions, but if you have a question, definitely raise your hand, and I would love to hear it for Jeremy. So this was sort of interesting. Jeremy, someone wrote in the chat, John Tan said, I guess there was, I guess he's talking about publicly traded REITs, and I don't know if I guess there's a discount to them right now in comparison to cap rates. Any thoughts on that?
Yeah.
John, is that, if you're on, I don't know if you want to unmute, you can maybe clarify the question or just talk about that question a little bit.
Yeah, I was seeing like REITs like EQR, for example. Sam Zell started that, so it's a pretty great company. It was trading at almost 90 beginning of the year, and now it's trading at 52. So it's a huge discount, and sort of just by calculating cap rate as much as I can, it's about almost 6% cap, and they have also a development wing and sort of additional business management wing to that. So the business should be worth more than that compared to what the actual sort of property they're selling in the open market. So that's why I was wondering, am I missing something, or which one's underpriced, overpriced, or just what's your thoughts on that?
Yeah, so thanks for that question. It's a great question, and it's actually an interesting thing to consider. I love Sam Zell. He's one of my favorite people to listen to because he just tells it like it is, and he's so smart. So, and he's great with timing. So first of all, I should have mentioned at the beginning here, I'm not a financial advisor, so anything I'm sharing is just my perspective, yes. Especially because it's stocks that we're talking about now. I am also not a REIT expert. I've never actually owned a publicly traded REIT. What I will say is this, though, directionally. REITs were heavily discounted when the stock market crashed earlier this year. That was fantastic timing. I wasn't focused on that, definitely missed an opportunity. I would pay very close attention to not necessarily what's discounted today, but which direction you think the stock market's heading in. Because if you think the stock market's going to be stable and not go down any further, you can start to look at these discounts. But at these levels, you really have to question why there's such a substantial discount. Like, I feel like something might be missed in that. If you told me that Sam Zell's company was on sale by 40% in March, I would say, okay, it'd be really interesting. If you're telling me it's on 40% on sale right now, where we're practically at all-time highs in the stock market still, that's something else to really dive into. I'd be very careful with that. My concern is that the stock market may take another leg down if we end up with less stimulus than everyone's expecting in the future. And that may be a really interesting time to be contrarian and really think about those publicly traded REITs. But I'd be concerned right now where we are with these levels.
Hey, Jeremy, the next question, Lana asked, is there merit to, instead of looking at just your going in cap, but looking at your going in cap and potentially residual versus the debt that you're putting on the property, right? So the spread between, let's say 3% debt and now 5% cap versus a 6 and a 4, if that makes any sense. Like
Yes.
keeping that delta spread.
Okay, so you're saying if you're, in other words, does it make sense to have a singular focus on making sure the spread is there?
Or just that if we were paying 6 caps on 4% debt, but now we're going to go down, we're paying 5 caps on 3% debt. Is it still a good deal, essentially, right? Because we still have that same spread.
Yeah, so here's the thing. I think all things being equal and with taking a few factors out, I think that's not a bad way to look at things. And James, I probably assume you would agree because I know this is an important point that you always talk about. And my take, though, is that the challenge with the spread is that it maybe gives you an idea of, well, A, how much leverage you're getting, which is important. B, are you investing at the right time to be able to get the right amount of leverage because the spreads change over time, right? But then it doesn't necessarily tell you. So what I guess it sounds to me like the question you're asking is, can cap rates change based off of anything else but interest rates? And I think the answer is yes. And that's really important to understand because a lot of people tend to just look at interest rates and say, interest rates are going to be lower in a year. And so, I'm protected from a pricing perspective. My answer is no. That's only one component of a cap rate. And so consumer sentiment, fear, less liquidity in the markets, like all these other things can affect the multiple somebody's willing to pay. And so I think the spread is important to look at so you're getting it at a right time from being fair to yourself as far as getting that proper spread as opposed to it being too narrow because the spread will eventually probably open up again. That's the way markets work. But at the same time, I think it's very important to understand that interest rate is not the only factor to look at in deciding if it's optimal time or not to go into a specific asset class. James, you're an expert on this. I know. Do you have anything to add?
Well, what's hard is that most passive investors really, the most important slide in the whole deck, essentially to most passive investors, is I put in 100,000. What am I getting in year 1, 2, 3, 4, 5? And not many people go past slide 1. Like a lot of people are like, all right, I'm getting 6%, 7%, and it's going to 8, then 9, and then I'm getting, 50% total return in the residual. All right, I'm good with this deal. They usually don't get into that detail. And so people like right now, if you get 5 years of IO and you get a 6, 7% cash on cash, the alternative is 0.001 in my Bank of America account. And so do I feel safe in doing a 5, 6, 7% cash on cash on a, with a good operator and a good market on a good property? Probably.
Yeah. So let me address that because I think it's a very important point. So because I'm just one person. So the way that I work, because I'm really low risk, is that I'd rather have cash for 2 years and optimize my timing, for example, which may even not be optimal, but just as an example, versus put every penny to work today. So what's going to happen is that in 40 years from now, James is going to be wealthier than me because he has a different philosophy, which is just another perspective that he wants to have his money working all the time, right? And I'm just not as comfortable with that. So what ends up happening is that if you're James and you believe that you want all your money working and that you believe that in 5 years from now, or whatever, 10 years, however much long the loan is for, that eventually inflation will pick up, the value of the property and you'll reduce your debt and you'll be fine, then frankly, that's a very sound strategy, honestly. But if you're like me, who has a different philosophy that I just rather take a little less risk and wait and then not necessarily have the same end amount of wealth down the line as the trade-off, then you end up sitting on the sidelines, right? So that's a bit of a philosophy question, and neither of them are wrong, obviously. What I will say is this, though, just to kind of give you a counterpoint, which is if we were in 2007 right now, January, okay, or June, and I said to you, James, you ready to invest in that deal that has great numbers looking on it? They look great on the paper. What would you say?
January 2007?
Yeah, June of 2007, right? So
June of 2007. Okay.
Yeah. So it's almost a rhetorical question in that I think what everybody needs to do is ask himself that question and say, okay, it's not just it's as important to look at the numbers as it is to understand where we are in the cycle and what your philosophy is, on what best for you and how you want to invest understanding where we are in the cycle, not just ignoring where we are in the cycle. That's the important part, right? Because if the answer to the question is, I'm going to invest in June of 2007 because, apartments are going to hold well, rents were down maybe 10% during that downturn on average in Class B, I'm just generalizing. I'm still going to get the cash flow. I'm going to keep my money at work. And by 2012 or 2017, my money's going to be okay. Then the answer is, I'll invest in June 2007. If you're like me and you say, holy crap, I want to invest in 2009 when the cap rate's adjusted 200 basis points, then you wait, right? And again, neither of them are wrong, but it's important to just take the time to understand where we are in the cycle and not just look at that one page. That's what my takeaway is, hopefully, for everybody, because I understand what you're saying and I don't disagree. A lot of people just look at page one, but they're not taking the macro into account. I think it's very important to do that.
So just to be fair, in 2007, I didn't know what the hell was going on. So I mean, I was only like, yeah. So so I wasn't investing in anything in 2007. So
yeah,
but I agree thinking about that scenario, and that is a fair scenario. And I mean, when I started investing in 2015, it had been running for a while, right? So multifamily had been running for a while in 2015. So people were like, all right, James, this is the top of the market. And so I sort of stair-stepped my way in and just did sort of one deal a quarter. And if there was a downturn, I was okay with that. Because I had to get started at some point. I mean, I would
argue that with multifamily is one of those asset classes like mobile home parks where you can make a pretty strong argument that if you're going to take the risk and not worry about the timing as much, it's probably a good asset class for that. On average, if you look at it long term, you're going to be okay, right? So I totally get that. It's just not what I do, but I totally understand that.
So this is an issue. Well, not an issue, but so now I get people send me Class A deals, Class B deals, Class C deals. Okay, and I see the risk in all three. All right, but I also see the advantages of all three. Based on where we are right now, what is the best class to invest in out of those three, in your opinion?
Great question. I think that there's based on where we are today, and I don't normally invest in Class A, but I think a lot of people would argue that Class A is the best way to go, and there's two reasons for it. One is because the spread that we talked about is very narrow and kind of makes it more enticing because it's not the traditional spread, right? Which also tells you what could happen to the Class B pricing eventually, right? Or the Class A pricing. But the bottom line is that there's two reasons why I say that. One is because the spread isn't there, so you don't have to take on a much higher price to get that Class A quality, and all the lack of deferred maintenance, the fact that it's actually going to have higher ceilings, is going to be more appealing to more people for longer term, and all this stuff, right? But the other piece about it is that if the recession does end up getting really bad, I mean, this recession has been unfortunately heavily weighted towards service sector, right? And that's a reality. So I would be very weary about Class B buildings because people are using that stimulus money right now to, probably a higher percentage of tenants are using that stimulus money to pay that rent check. And what happens if that goes away, right? And so I think there's a higher risk of that versus the Class A, for example. And I think there's a compelling argument to be made of a Class A versus Class B that's actually been there now probably for a year or two now going on.
And C?
Well, that's what I talked about the worst. I'm sorry, I meant to address the worst.
B and C? You think it's B? Okay.
No, so I think the C is a risk because I think probably a disproportionate amount of people were using stimulus checks because a lot of those are service workers to actually make those payments. And I think there's a lot of risk going forward as to whether those people will continue to be able to pay. So sorry for the lack of clarification. I think that A has the least amount of risk and C has the most amount of risk and B is probably somewhere in between, but isn't as compelling from a pricing perspective.
So yeah, I mean, I would buy A's all day if it was the same cap rate, which it pretty much is, probably 50 basis points, maybe 100 basis points spread between A, B, and C right now. But the challenge is that when you're an A, you just can't push rents. Like rents are just, there's new supply and people are, here in Dallas, I mean, there's 30,000 units going up.
But, you bring up a great point. So keep in mind when I'm answering for myself looking for predictable cash flow.
Right.
And you're looking for to push rents for some appreciation. So good point. I guess depending on what your strategy is, that answer may vary for sure.
So if you look at a Class A deal and you're saying, all right, my cash on cash is 6 and I'm okay with 6% because there's limited deferred maintenance. It's a good property in a good area. and it was recently constructed, and I can clip a 6% coupon without a lot of risk, that you feel comfortable with that deal more so than sort of a B minus C deal, which might have more deferred maintenance particularly?
Well, yeah, but I'm less concerned about the deferred maintenance right this second. I'm more interested in the fact that you're getting technically a better deal from a cap rate perspective on an A versus B because of the spread. And the fact that you've got, in my opinion, less risk of people not paying in the next 12, 24 months if you're looking for predictable cash flow compared to a B minus or a C. So,
Okay.
but that's just where my head goes because of the type of stuff I'm looking for.
All right. I'm gonna attempt to do like a quick fire round with very quick answers. Is that fair, Jeremy?
Oh yeah, no problem at all.
All right. So we got like 30 questions. So we're just gonna fire up you. I think you hit most of these, but let's just so we hit manage. Anything else on this? Manage or check on your investments?
I think you tell me, but I think we covered it. But I'm happy,
Okay, we hit. All right, we didn't touch on this one. Dave asked alternatives to multifamily right now. Sort of what's your maybe top 2 or 3?
Yeah, look, I invest for predictable cash flow, right? So because I'm looking for that predictability. So I would say that good alternatives would include mobile home parks for sure, RV parks in the right type and the right location as well. Right now, senior living is tough, but I think it's a fantastic asset class for the next 10 years due to the demand growth because of the aging population. And self-storage has been very strong in a lot of different locations, and I think it's going to be strong for the next 10 years. But I would strongly recommend looking at growth states, obviously. You do not want to be caught on the wrong side of that when you're investing in a state with population leaving, because you're not going to be able to replace those tenants.
Got it. All right. Key criteria, investing with a GP. And then how do you deal with, like whenever I get a package from a GP, like I feel bad if I tell them no. How do you deal with that? Does that make sense?
Yeah, and so actually that does make sense. And I'm sorry because my windows. Well, let me put them up top. Sorry, just trying to figure out how to. Oh, here we go. I can't see the whole question. Here we go. On the specific deal. Okay, so answer your question. Declining a GP. I think it depends on what the intention is. I think that if let's say somebody brings me a deal where the split's like 40 for the investor, 60 for the GP. Happens like once a year, every year. Okay.
It's pretty high.
Yeah. And I'll just decline and say this isn't a fit for me and move on. I don't care if I'm hurting their feelings because I don't think they're being fair. Right. I don't say it in any bad way. Just saying like I'm passing, this isn't a fit for me. You can use all kinds of excuses if you want. I can give you excuses if you want. You can use lack of liquidity, the timing is wrong. I'm waiting for some other liquidity and it didn't happen, so now I can't. But you can use a lot of excuses, right?
So I'm fine using those excuses, but then a lot of times, let's say somebody will mention like, "Oh yeah, I'm under contract on a deal. Let me know." And so you reach out to that general partner and you're like, "Hey, can you send me the deal?" And then you're like, "Oh, never mind." And after you do that a couple of times, I feel like they're just gonna stop sending you deals. Is that?
I tell you what I do, honestly,
Yeah.
because I think it's a fair question. What I do in those types of scenarios, I tell people why I'm passing, because it's all about the numbers typically, and I don't want anyone to be offended, right? So if you say, look, I've been at, this cycle, I've had a very hard 9% cash on cash year one target. You're at 7. I just can't do it because I have limited capital to invest. They're gonna fill up. I don't think it's really being, I think it's being pretty fair. You're being honest, I don't think you're going to hurt anyone's feelings if you're saying I have very strict criteria. Like it's no offense to you whatsoever.
So answering with rules. Essentially, that's I think it was Ryan Holiday just wrote a post about if you answer emails and you just say, "Hey, it's against my rules to do this," then people are fine. You actually aren't hurting their feelings. So,
yeah, I think that works.
All right. Do you see increases in rent and occupancy over the next 12 months?
I see it's going to vary by stimulus. It really depends on how much stimulus is going to roll out. I think in the first 100 days of the next presidency or the same president, whatever happens. I am much more concerned about decreases in rent and decreases in occupancy rate over the next 12 months than increases, right? And of course, I'm going to be more concerned about that because that's a downside risk. But if you ask me probability-wise, I would say 60-40, 70-30, those are going to be lower. But what will help them is stimulus. I think without the stimulus, almost certainly they'd be lower, but that hasn't happened yet. So that's why I go back to why I say I think things are delayed. And the question is, what will they really look like when they finally show themselves? And that's a risk right there.
So what's going to happen? No stimulus for the rest of the year, no stimulus in 2021. What happens to apartments?
What happens to apartments is what would normally happen in a regular downturn. There's a bunch of dominoes that fall, right? So first thing that happens is some people can no longer afford the rent. Okay, so they have to leave. They got to either go home or they got to double up with other people. Your vacancy rate goes up. What happens is that it's not just your vacancy rate, it's also your neighbor's vacancy rate. So now there's more supply in that immediate area, right? When there's more supply, there's going to be more concessions, and eventually rents are going to come down, right? What happens when rents come down is that the building you own has a lower NOI, and effectively your building's worth less at the exact same price. But the other unfortunate effect is that when all this happens, investors start to get scared because they see what's going on in the markets. There's a recession that's actually kicking in. Stock market's probably going to be affected. And now you've got consumer sentiment and investor sentiment down. That means there's actually less investors willing to invest or even having the money to invest right now because they may have just lost their job or they lost 30% on the stock market portfolio. What happens as a result of that is you got buildings that have lower NOIs combined with increased cap rates, increased cap rates, right? Because people are willing to pay lower multiples, and you have this double whammy of like this building became worth less because of a lower NOI and worth less because of a increase in cap rates. And so that's what would normally play out. And then eventually what happens is that you've got people asking a certain amount for a building, and you've got buyers realizing this is all occurring, and there's this big spread between the bid and the ask, so to speak. It takes about 6 to 12 months. The bid-ask spread starts to close, and then you will eventually hit a trough in the recession within about a year after that, where we see kind of the trough in pricing, right? When everybody capitulates, sells, and then we really see what things clear for. So I'm just giving you the typical playbook. I don't know what's going to really happen.
So I feel like that happened for 1 month.
It did. I actually saw it happen for about a month or two. It did.
For 1 month.
So what happened? That's why I keep going back to this process. The process was delayed. The dominoes fell, and someone came in with stimulus and put them all back up. And they're still on the line. They can still fall. Take the stimulus away, they're going to fall again, right? Right now, they're all up, and it looks like everything's totally fine. And it looks like they never fell. And that's what it feels like. And that's why I'm trying to stress. Everything's been delayed. The dominoes falling have been delayed. Will they fall? Will they all fall? Will there be a partial stimulus that will cause 2 of them to fall instead of 4? So it won't be as bad. We don't know. But if you're investing today, there's no doubt in my mind that you have the risk they can all fall or partially fall
again. All right. James, not me. Most important thing you look for in a GP?
Well, look, the absolute most important thing is I want a conservative GP with integrity. And I want someone with experience and those items as well. But you want a conservative GP with a lot of integrity who's looking to do the right thing for investors.
Perfect. What's going on with cap rates?
I think we covered that, right?
Yeah. Have you seen any changes in the last 6 months that bring you closer to investing again, heavily again?
I would say not yet, because we haven't seen the reality of a recession. We don't know if we're going to or not. So not yet.
Okay. We covered current investments. All right. I love this question. How do you not be successful investing as a passive? Like, give me all the stuff that bad passives do. How are you not successful as a passive?
Yeah, so great. I've actually never had that question before. I like the way that was phrased. So good job, Kumar. So number one, you don't do background checks. So you don't know for sure if you're investing with a criminal. Number two, you never talk to the sponsor at all and just look at the thing and you have no clue of like what type of personality you're making a bet on. Number three is that you just take every single number for face value and assume that everything is correct. By the way, that, you won't check any numbers because you're just assuming they're all correct without actually checking. It's a trust but verify situation, but you don't verify, right? You don't verify whether the comps look right. You don't verify if they use fair rent comps, sales comps. You don't verify whether they use fair revenue and expense inflation assumptions. You don't verify whether you agree with the type of multiple that was used at the back end to make the numbers look better. There's a lot of stuff you don't do, and then you become a great unsuccessful passive investor.
So you don't know the general partner, you don't know the property. Somehow you got invited to the deal, and we need the wire tomorrow, right?
Yes. And the simplest way to actually be a great bad passive investor is to just get a deal from a friend and invest in it that night. and not even looking. And that's
we got to know right now. We got to.
That's unfortunately that's how Madoff happens, right? That's how Madoff exists. So that's a very good way to not be a successful passive investor.
Have you done any recent passive deals? If so, what were they in?
So since COVID, I have invested in one debt, kind of not even a debt deal. It was a non-real estate deal. So it's not even worth getting into. What else have I done since COVID? That's it. I've been really, really careful. I did a bunch of stuff leading into March, fully expecting a recession. A lot of stuff between like November and February, fully expecting recession, still thinking that what I was investing was going to work well in recession.
Any real estate specific stuff that you can share?
Yeah, RV park investment, mobile home park investment, senior living investment, all stuff that works during a recession. Now, a pandemic's a different story. You know, pandemic on a senior living, that's a different story. But all that stuff works into a recession, and I was fully expecting a recession at some point.
How do cap rates returns compare on RV? I've not done those. RV, mobile home park compared to multifamily.
The problem with mobile home parks is that mobile home parks have gotten to the point now where kind of a comparable, I would call class B, 3-4 star, maybe 3.5 star park. They've gotten to the point where like they're looking at 5.5 caps. So they're not too far off from a proper class B in a good city like Dallas, which is not great if you're trying to be careful, right? And it's also
so you're buying a class D deal.
What's that?
Would you consider that like a class C multifamily deal? Mobile home park or no?
Well,
or is that not fair?
Because you can get kind of 1-star, 2-star parks that are more equivalent to class C. I was trying to compare like an apples to apples, like a class B to like a 3-star park.
Okay.
So, they've compressed a lot. RV parks have compressed a lot too, but they've held a little better because they tend to be a little bit less predictable on average. So you're going to get a better cap rate because you're basically having to take on additional risk, a lot more fluctuation.
All right. Let's keep going. Let's see. Largest change on your evaluation of passive deals post-COVID?
I think we covered that based on how I'm going to reset my target criteria to the new cycle.
I think we talked multifamily. All right. LNS, minimum cash on cash that you or investors should consider for new deals. Do you have any targets?
Yeah, so I don't have targets yet because the cycle hasn't reset, so I'm going to actually establish those. But I will tell you my minimum target last cycle was 9% projected net to investors year one on a Class B multifamily as an example, which became unrealistic probably as of about 2014 on average. I'm hoping I'll be able to hit 8% year one net to investors when cycle resets, if it resets. But
on IO or amortizing debt?
What's that?
Is it on IO or amortizing?
Amortizing debt. Yeah. James is looking at me like I'm nuts, but we're going to have to see.
I'm looking at you like you got 3 eyes, man.
The reality is that, here's the reality that, like, I want to be clear to everybody. This is not a question I should answer yet because the reality is I have to let the market tell me what's realistic. I can't demand something or I'm going to be sitting here not investing for 20 years, right?
Right. Understood.
It's not a good question for me to answer right now, but I'm just giving you a hope more than anything.
I'm hoping for it too, man. I'm hoping for it. What additional information besides the slide deck should I ask for when evaluating a passive deal?
Can we
top three things?
Okay, I was going to say skip one because we talked about this stuff, but let's see. So I would say you want to get, it depends what's in the deck. So you definitely want to get track record and experience and understand how long they've been operating. You want to get a good sense of the team's history and look at the bios for sure. And it depends on whether that's in there or not. Sometimes if you're able to, you get a hold of the live spreadsheets, so you can run your own scenario analyses or at least look at the line. So if it's just high level returns, but you're not giving like a line item broken down projections, I would at the very least, even if it's a PDF form, get the line item revenue and expenses so you can understand what assumptions are being made, what type of expense ratio is being used, and then you can back into what revenue and expense inflation assumptions were made for different items. That you definitely want to get that if you don't have it.
Definitely. What should people be conservative about when underwriting deals right now?
I think that it's important to be conservative about what your opinion is about the next 12 months. Meaning that if you think there's a chance that rents can go down, the one thing that I've only seen it once in my entire 18 years of investing, a 10-year pro forma that included in multifamily a reduction in rents in a given year because someone took their best guess as to when there would be a recession, right? So if you're trying to be conservative, adjust for a possible reduction in rents if there's no stimulus, and then see what the cash flow looks like, and then see what your eventual exit looks like.
Cap rates up or down? That's a tough one. We'll skip that one unless you got some commentary.
No, and James, honestly, James, I've been teasing James a lot today. I'm really sorry, James, but
no, you're good.
James is a great guy. If you guys do not know him, I'm not here to plug him, but he's a wealth of information. He's extremely knowledgeable because of what he works on the lending side. So he's a great person to talk to this stuff like that about.
This Michael asks, what would you look for in a syndicator if they did not have direct multifamily experience?
Good question. So if someone was brand new trying to do multifamily, I would look for either them having worked on an asset that's somewhat similar, right? So if somebody did office versus multifamily, a little bit different, right? If somebody did mobile home parks, like residential, starting to get closer. If somebody did smaller duplexes, triplexes, that's starting to be a pretty good fit. If they did single family homes, even they're managing tenants, that to me is a better fit than somebody who's been managing a senior living facility, right? So I would look at that. I look at how many years experience they have. And frankly, one thing that I definitely give weight to is someone who's not been a syndicator before, but perhaps was working for a syndicator, especially if they're doing underwriting a lot of key things for many years, or worked in some type of real estate initiative for many years that's very relevant to what they're going to be doing. I think you do need to give credit to an extent, depending on what the exact role was.
Okay. Lana asks, other than sponsor, top 5 when deciding to invest?
Other than sponsor. So to be clear, my opinion is that the sponsor is even more important than the property. So it's my number one, right? Okay. So then after that, it's going to be all about the property. It's like, is it going to, obviously it has to hit the returns I'm looking for, has to be conservative underwriting. That's a huge component. It's got to be in a market that I think is actually going to grow and that I think is going to be in demand. It's got to be an asset class that I think makes sense for the next 10 years because I usually invest long term and I have to think about very far out. And I think, unfortunately, a lot of investors don't think that far out. But will that asset class be relevant in 10 years, or are you about to invest the equivalent of like Best Buy, anchored huge big box retail center in 2010 and you're going to hold it 2020? That's going to be a problem, right? So you've got to take a look at technologies, innovations that are coming up and how that's going to potentially impact your ability to then sell that property and demand for that property in 10 years from now, not just in 2 or 3 years from now. I think we're missing one more criteria. Can we stop maybe at that? Those are important ones.
Yeah. David asks, any tips for new sponsors to gain the trust of investors?
I think that if you're a brand new sponsor, which I know is tough, and let's say you're looking to raise capital, but you've got a minimal network to raise that capital from, I think one of the really important, two of the really important things you could do is just really make it obvious that you're trying to be very careful and conservative, perhaps if you can, with a pretty large co-invest. So you come in and co-invest a certain amount to show people you've got a lot of skin in the game. The other thing you could definitely do is, you can give a better split or a better preferred return or both and make your deal a little bit more attractive. So you're willing to get more profit because someone's going to take a risk on you. Because the reality is that if I'm an investor looking at your deal on your first time, I'm taking a lot more risk because you haven't learned certain things. Therefore, I should be getting more of the profit and more of the reward to adjust for that risk, all things being equal. So if you're willing to give that up, make it more attractive, co-invest a little bit more, you're going to have a little bit less hurdles to finding people, but obviously it's still going to be challenging.
That is the best answer that I have heard on that question.
Thank you.
Because I get that question a lot. And the reality is, like, I've invested with people who have less experience and the deal might not perform as well as someone who has done this for 20 years. But the guy who's done this for 20 years, he's taking 40% of the deal after you hit like a 13% IRR, right? And so all the upside's going to the general partner. So you're sort of capped at, let's say, a 15% IRR. But the guy who did his first, second, third, fourth deal, he's taking he put in a lot of money on his own and he took a lower split and he might not hit a home run, but if he hits a double, I hit a double. And so I think that's a way for new sponsors to get in the game and actually get started. So that was a very good answer.
Oh, thanks. Yeah, and I want to add one more thing too, because to your point, another thing you can do to help, because what you're essentially doing is reducing risk for investors, right? And another way you can risk is bring them an amazing deal combined with really good returns. Because again, if you're buying it right, you're now reducing risk. If you're offering them the right splits and profit share, you're reducing risk, and now you're like reducing the hurdles for them to invest with you. So
Perfect. We got a couple more if you've got a couple more minutes.
I got time, no problem.
Paul asks, when will the distressed properties appear?
Great question. I think that's going to have a lot to do. So if you're talking about multifamily here, is that a fair assumption?
Yes.
So yeah, I mean, look, that's not going to happen. Look, there's always a little distress, right? People get over levered, things happen. But if you're talking about major distress from a downturn, that's not going to happen until two things happen. A, stimulus is gone, and B, you wait enough time for that stimulus to be gone for the distress to occur. So if I had to guess right now, I think the minimum time when we're looking at is, let's say there's never any more stimulus, right? You're gonna, and by the way, evictions are finally off January 1st. I'm making that up, right? Then you're probably gonna see some distress within several months after that, and that's when the deals are gonna start to show up. It's gonna take at least a few months from that time. People are gonna try and hold on to the buildings, do what they can. You shouldn't really expect to see much distress until probably at least halfway through 2021 at the earliest. But if there's a lot of stimulus, that's a whole different story.
Markets, I think we touched on that. Market changing to a buyer's market. Any comments on that?
Yeah, I think that the market will change if there isn't stimulus and if the typical dominoes fall. I'm sorry if I sound like a broken record, but that's really when it happens, right? And it happens and it takes time. I talked about that before. The market doesn't just shift overnight. What happens is that the sellers still demanding a certain price, and that the normal process is that it takes a long time for the sellers to capitulate and realize, it's like someone who's listing a house at last year's price, but it's worth less. It's going to take them a while before they actually realize, I'm not going to get it. I've got to reduce it. It's this exact same thing that happens when it shifts to a buyer's market. It takes a while. So I expect that process to take a good 6 to 12 months once it starts.
I saw it for 1 month.
Yeah.
March 15th to April 15th.
Right.
That was the only time that I saw it.
And that's exactly right. And part of that was what I was telling you before, is that those sponsors weren't able to raise the capital even they needed, right? So that's just a lack of buyers in the market will create a buyer's market to an extent, right? The lack of liquidity. So you're right. That's what that's what we should have seen happen. If there was no stimulus, that's what would have happened if there was no stimulus. And we have to wait and see what happens still.
Largest concerns with multifamily, and how do you mitigate that?
I think that one way to mitigate concerns about multifamily is to make sure you're investing in the right class for you and the right business plan for you, right? So don't go into a development deal if that's the wrong type of deal for you, because that could last. The timeline could be very different than you thought. The return could be different. That's a certain level of risk that may not be really align well with you. But then when it comes down to types, I think it's very important to understand what you're most comfortable with as far as the actual class of multifamily you're investing in, right? Are you the type of person who wants to be in the new shiny building with very little maintenance and deferred maintenance, but you're going to get lower returns? If yes, that's perfectly fine. Are you the type of middle of the road person like me who likes to be lower risk, but likes to get a little bit more return and kind of go class B, right? Just to simplify it. Or do you want to get a little bit higher returns knowing collections may not be quite as predictable, and you may have some other challenges, some more deferred maintenance that may or may not be predictable on a class C building? So I think one way to mitigate the risk is to actually go into the right type of opportunity up front. Same thing with value add versus stabilized. And I would also recommend mitigating your risk if you're going to be a value add investor, depending where we are in the cycle. I kept telling everybody last cycle, I'll invest in value add at the beginning of a cycle, but not the end of a cycle. Guess what type of deals you were seeing at the end of a cycle? The only thing you could find is value add, because the sponsors knew that if they bought at the crazy cap rates on a stabilized deal, that the investors were going to be interested. So now you're seeing engineering of preferred equity to have higher returns. All these things that happen at the end of the cycle when everything's too expensive to still attract investors, right? So one way you can mitigate risk to yourself is say, I understand where I am in the cycle. I understand what risk I'm willing to take, and I understand when I'm willing to take that risk within the cycle as well.
Okay, I'm going to interject my own question here. What do you think about, all right, so you look at the capital stack, there's debt, and then there's equity. There's two pieces of equity. One is let's call it class A, and you get 8% every year preferred, but then you get no upside. And then they do, let's say, a sliver of that. And then you have the class B piece, which is nothing's guaranteed, but you participate in the upside.
Mhm.
What are your thoughts between those two different classes of equity?
So I have a few thoughts about it. If you say overall at any random time in a cycle, I don't invest in preferred equity. I have actually a few times been in very odd exceptions. It's one of those things like a no-brainer where the effective loan to value was so low and the return was so high, it's like, I got to do it. But that's not what we're looking at today, right? And what we're seeing, they're just trying to make it attractive enough. So generally I don't participate in it because I invest in more stabilized stuff, and therefore I like to have some upside on the back end if I'm going to get it, because I'm already investing with relatively low risk. So I don't want to limit the return when I'm already getting a relatively low return. The other thing is right now, though, if I had to choose, somebody put a gun to my head and said, you got to invest in this multifamily deal today. You're going to take the preferred equity or the equity on the typical deal I'm seeing that are going out there like that. I would definitely take the preferred equity, because if I think there could be some risk coming up with rents and everything else, I'm going to be ahead of the common equity in the capital stack. So if I'm a lower risk person, I'll take that preferred equity. But that's if someone forced me to. I wouldn't do it for that purpose in general. And I wouldn't invest in that deal right now anyway, as you know. So
is it 8, 9, 10%? Does it matter? At what level do you become more comfortable?
Yeah, personally, I've always become more comfortable double digits, but that may need to adjust after I see how the cycle changes next time and where we really land with cap rates.
Tori asks, how do you recommend getting started in multifamily investing as a passive?
Yeah, so I actually do have some recommendations for this. Can I assume Tori is accredited?
Well, sure. That's fine.
Okay. So if Tori's accredited, then what I recommend that Tori does is say, okay, before you even consider a multifamily deal, get exposure to opportunities. I call it opportunity exposure. Read enough deals that you start to understand what a typical split is, what a typical preferred return is, what looks off as far as what's better or worse than normal, and start to hone in on what you're looking for or what your criteria should be. What is a typical rent inflation assumption and expense inflation assumption? What's a typical exit price and multiple that a typical deal looks like? And how do you recognize that something looks off because you've seen 20 other deals and you realize that exit cap rate that's a 2 doesn't look right, right? So it's important to get opportunity exposure. The easiest way right now with technology to do that, in my opinion, is to go onto a bunch of crowdfunding websites. If you're accredited, that's why I asked that question. And just in your pajamas, you can download 10, 20, 30 deals right now in an hour, print them all, and just start reading them and putting them side by side and getting to know what makes sense for you, what criteria you're going to create for yourself, and even what type of business plan is the right fit for you from a risk perspective. So that's my recommendation for someone just starting.
Jeremy, that sounds like a lot of work I want to be passive.
So there's an easier way to do it. You could take the deal that your friend just sent you and invest in it, right?
Yes.
So look, you can obviously look at 3 deals or 5 deals if you want. It's just that if you're really going to do this right, and, I would tell Tori, look, this is a really interesting time because the cycle is either reset or about to reset. So you're going from you're maybe going into the best time to invest, the beginning of a cycle. So you've got really good timing and you're not going to miss out on much. If you just read for the next 4 months during the elections, you're not going to miss out on much, right? So yeah, I don't know. I think that nothing substitutes doing a lot of work up front to learn, to really understand what you're getting into. So
absolutely. I agree. I think this is the last one here. And I actually don't know the answer at all. Is there a Blockbuster / Netflix moment coming to multifamily? So yeah, I don't know.
Actually, I'm going to give a crack at this, and this is very speculative, but I could tell you, I actually know someone, not well, but someone who has a real estate at Uber, who had told me that they were actually, and this goes back a couple of years already, they're testing flying drones, right? And those are eventually potentially start to come up maybe 2023, 2025. And what they were doing is they were actually considering striking deals with larger multifamily complexes to be able to have landing rights on the roofs. Okay. So, the question is that going to change everything in terms of food delivery? Is it going to change everything as to where you want to live or not want to live? Is it going to change everything as to where you're willing to commute or not? Because you can get into that actual vehicle and go to your work. And so I guess I'm answering this the backwards way, where I don't know that multifamily is necessarily going to have a huge Blockbuster Netflix moment, aside from having a lot of internet connectivity and work from home. So you can argue, I guess, that the work from home layout might be better, but I mean, anyone's typical multifamily room could be turned into work from home with a desk, right? The bigger question is what technologies could disrupt where people want to live in multifamily or not want to live in multifamily, in my opinion, in the next 10 years. I will give you one though. I have a very strong opinion that in the next cycle, I'm probably going to be targeting only buildings that have 9-foot ceilings. Because structurally, if you've got an 8-foot ceiling and that's becoming more and more demand going forward, then you cannot change that unless you tear the whole thing down. So if I want to avoid someone having an issue with the building that has an 8-foot ceiling and 5 or 10 years from now when there's less and less demand for that building, that blockbuster Netflix moment, so to speak, is a newer type of ceiling height that can't be changed, that you could be stuck with or not stuck with depending on your investing choice today. So that's about the closest I come to that on that type of question.
Yeah, it's funny. When I walk a property that's 1980s property, and I say to the leasing agent, "Do buyers care if it's an 8-foot ceiling?" They're like, "It's an 8-foot ceiling?" Like they have no idea. Like half the time, they don't even notice. I mean, they've just worked in that property, and they just haven't. They don't go to the property. I guess everywhere they've lived, it's been 8-foot ceiling. So, I mean, I think if you are trying to take it from a B deal to an A- deal and you want to compete against A- product, absolutely, I think you have to have the 9-foot ceilings and washer dryer connections.
But James, I would argue that if you're investing in that building today and you're selling it in 7 or 10 years, you're no longer a B building if you don't have the 9-foot ceiling at that point, and that's a problem because you're going to get a Class C cap rate. So that's why thinking ahead is so important.
I agree. What happens is when there is a 9-foot ceiling and washer and dryer connections, you almost pay a cap rate right now, unfortunately.
Yeah.
You know what I mean? Like it's almost built into the price that you have to pay right now.
Yeah, and that goes back to like the spread between the two anyway. And like today's investing, it might make sense to go into a Class A building. But in a year or two, that might be something to consider, though. It might be different.
Jeremy, thank you very much. I will open it up. Those are all the questions I had and all the questions I received. So thank you very much for doing that. I know you had no water or no chance to even get water. So I appreciate you answering those. I'm going to open it back up to the group and see if anybody has any questions or just wants to raise their hand and introduce themselves to the group. I would love to sort of hear from you guys if you have your camera on or can jump in here. We'll try to raise your hand.
And can I just say real quick, hopefully this was helpful for everybody. Obviously, I just want to thank you again for having me on. And I have until about 3:40 my time, so another 25.
Okay. Yeah, no problem. Okay. Anybody have any follow-up questions? Or yeah, go ahead, Layla. I think you can unmute yourself. I think I took that off.
I think I just did. Hi, Jeremy, and hi, everybody else. Jeremy, first of all, thank you so much for sharing the information. I always love listening to you talk. I have a question for you. At this point, for real estate professionals, to what extent should that tax benefit, the bonus depreciation, factor into analyzing deals as a passive investor?
It's for real estate professionals. Yeah, look, I am not a tax advisor, so, and I will tell you, I have a real estate broker's license, but because I mostly just invest passively and I have all this depreciation flow through, I don't ever really even use that aspect of things. So bonus depreciation can be very powerful to offset against your active income, but I am not a tax person, so I don't want to give you the wrong advice, so I don't do it myself. So, but it is a consideration. I will say this too, I think that with taxes the way they've been and with taxes potentially going up depending on who gets elected, depreciation, other things, all these things are at risk of changing, right? So if you can get bonus depreciation this year, for example, that may not be retroactively changed, which we don't know, then that might be a benefit. And I'm looking, for example, at capital gains. Capital gains tax rate can change completely as of next year, and hopefully not retroactive this year. We'll see, but I'm currently selling some stuff that's hopefully going to benefit from that. So that's a good question. I don't have a perfect answer for you, but it's definitely a consideration for sure.
A quick follow-up question to that. Do you consider that a risk? I know that the government is capping out that depreciation that you can take. I know a lot of people are in this asset class for that one reason, amongst many other reasons. But do you consider that to be a risk for the entire multi-class? When that, if the tax rules change, and if that bonus depreciation goes away or gets phased out, do you think capital is going to flow out of this asset class into some other classes? Do you consider that a risk?
Yeah, look, in my experience, it's a slight risk, but there's so much money that's looking to invest. I mean, I think that I guess for someone like you, it might make a difference, right? Because if you're looking to capture that bonus depreciation and you may not otherwise choose to invest in real estate because of it, maybe. But I think most of the passive investors, for example, some of them benefit from the bonus depreciation. A lot of deals I see don't have any bonus depreciation, for example. And so I think a much more powerful problem we potentially have is if we cannot get the more traditional straight line depreciation that we're used to, and therefore all of a sudden the concept of, I can get $1,000 in cash flow from this property, but all that is deferred until the last year when I actually have recapture. If that goes away, and then we're starting to lose that advantage, now real estate becomes a less appealing on a more to everybody that's in it, as opposed to the people that can really capture the benefit of the bonus depreciation, if that makes sense. So I'm less concerned about the bonus depreciation, more concerned about the overall depreciation rules.
All right. Anybody else?
I have a question. Can you hear me? This is Lisa Hilton.
Yeah, go ahead, Lisa.
So my question is to Jeremy. Thank you again for both of you for having this. Do you invest in industrial? Maybe you talked about this earlier, and I missed it because I was a little bit late. I was wondering about whether you invest in any like sale, lease buybacks, and like what are some of the things you look for or look at when deciding to invest in those investments, if you do?
Got it. Yeah, Lisa, I hope you're doing well. I have a few thoughts about industrial. Now, keep in mind, everybody listening to this, I invest for predictability. So even with the Amazon effect, I have invested in a few industrial deals in the past, but I've really shied away in the past few years, even though the asset class has done really well, because what's been very challenging for me was to get a read on where is that industrial going to be demanded in the future, 5-10 years from now. That was very tough, and it continues to be tough. So originally where I had the challenge was Amazon's coming up doing Prime Now and doing these other things and getting same day or next day delivery. And a lot of that required them to become much more local as far as their warehouses. So all of a sudden, you had them shifting towards buying these buildings that normally you would have never thought they would have used potentially in this right near your suburb that they're now using, right? And and so that was a lack of predictability that really worried me, and I kind of stepped out. I just couldn't figure that out. Okay, where was the demand going to be? Now the challenge that I have is that I think Amazon's looking at buying one of the biggest owners of retail indoor enclosed malls as a possibility. And the reason why is because they want to take all these malls and repurpose them into distribution centers. And those are effectively warehouses, right? And so what happens now, you have this, what you thought was a really attractive Amazon warehouse in your local area, right? Or that you thought was going to be used for that purpose, but now it's being shifted to a mall that has to be repurposed for a different and better use they could buy really cheap, right? That no one else wants. So the constant state of flux in where the demand will be for that asset has been made it really difficult for me to look at industrial in the past, I'd say 5 years. The irony is that, like, you can argue it's been one of the best performing asset classes. I've definitely missed out, but because I look for that predictability and I try to really be careful with that, I've missed out on it. But I actually wouldn't change what I did, and I still don't change my opinion today. It's very hard to predict. So that's my take on it.
So just real quick so when I was at G Capital, we did industrial bridge loans and CMBS loans. And the challenge with industrial that I saw when I was an underwriter was that typically most of these buildings have maybe 1, 2, 3 tenants, maybe. Most of them were single tenant. And so if that one tenant or those couple tenants moved out, you went from 100% to 60% to 20%. And when you looked at your box, it was just like everybody else's box. And it was very difficult if new supply came in and did higher ceilings and fancier, loading docks and all this other stuff. And so we had to take back some industrial properties when that happened. Right now, everybody's paying their rent still on industrial. So you're seeing collection still at like 99% for collection or for industrial because everyone's still paying right now because those are corporate leases. So it's good and bad.
Yeah, I would just add also another part of the question Lisa asked, I forgot to answer, was that I don't do triple net, single tenant deals. And I also don't like single tenant or just two tenant deals in industrial because I look for tenant diversification. That's another reason why it's always been hard for me to invest in it, even when I was more active in industrial. I like to have an industrial building if I can have more than 10 tenants or 13 tenants. There are some that are carved out like that, but there's a lot like James was referring to. There are just 1 tenant or 2 tenants, and it's it's tough.
Got it. Thank you.
Any other questions or people that want to introduce themselves to the group?
A question.
Yeah, go
Thank
ahead,
you,
Alan.
Jeremy and James.
Yeah.
Appreciate always great insights. Specifically for multifamily, Jeremy, when you think about a given good market that you're interested in and you're going to make an investment, do you give any weight on infill locations versus suburban? Any preference there?
That's a good question. To be totally honest with you, I don't get involved in that much real infill. Like I'm thinking, like I live in LA, just an amazing example of an infill market. Because in these types of markets, often the cap rates are very challenging. Whereas in the stuff that's more suburban, that tend to be where you find a lot of Class B there. There's more land, and that's the type of stuff I tend to invest in more readily because of the fact that it's a less volatile market. So reality is that if there was infill that wasn't that volatile, I'd definitely look at it. And you got to be very careful though if you're investing in suburban. Let's say the sprawl effect and also where money actually flows to over a cycle changes. So very often you see people chasing yield into Class C or into tertiary markets at the end of a cycle. So just be careful if you're looking at a suburban area that's a little bit even further out. You're like the next ring away, and that could eventually come back to bite you because you did it at the end of a cycle. You're really reaching for yield, and you may have a problem because you have more susceptibility to change the pricing after that cycle adjusts again. That's the only thing I would tell you to watch out for on the suburban side.
Sounds good. Thanks. Appreciate it.
Yeah, no problem.
Hey,
Any
James.
other- Yeah, go ahead, Malay.
This is James. I live in LA myself. I was late, sorry, so you must have talked about this. You talked about some of the markets being crowded. So how do you actually pick, and where are you looking at as far as multifamily?
I guess clarify the question. What
So,
markets should we be looking in as an investor? Okay.
Right. So I guess you talked about some of the markets being crowded and, you shouldn't be looking at. So just curious to see what markets are you looking at right now as far as multifamily? If somebody were to give you a deck, what would you consider?
James, is that for you or for me, you think?
You can take it, Jeremy.
Okay. So my quick answer, we did talk about it before, but real quick, I actually am open to any market going in potentially, but then I'm almost like a process of elimination as opposed to like inclusion. So I'm not targeting specific markets. I don't recommend specific markets necessarily. You obviously want to be in a market that's going to have a lot of population growth projected and stay away from what doesn't have that. But I tend to stay away from stuff that's really volatile, that's hot, and where the population growth isn't projected to be there. I'm open to pretty much anything else. So for me, the better way to answer the question is what don't I look at? Because I've invested across like 43 states, not just in multifamily, but in general. And I've learned over the years that there's a ton of great markets you and I have never heard of even that can make a lot of sense if you're willing to be open to them. So I would approach it more like don't pigeonhole yourself into 1, 2, 3 markets necessarily, and certainly stay away from those markets if they're hot and you're hearing about them from everybody else over a number of years at this point. But it's not a perfect answer, but I look at it a little bit of a different way.
Great. We got 2 minutes. Any other questions out there? Maya, does your son have a question? All right. Oh, well, I appreciate you guys jumping on. I'll send out the recording to everyone who registered. And if you have any questions about anything, so we're going to have, I think the next one next week on Wednesday, we're going to have Neil Bawa. And then the week after that, we are going to have JP Conklin of Pinsford on. So those are 2 of the smartest guys up there with Jeremy. So definitely register for those. And I will see you guys next week.